Good morning, everybody, and welcome to this webinar. We're really happy to have everyone join. We're very excited with the discussion that we have planned for today. I'm going to start with some quick housekeeping. The webinar will be moderated by my colleague Sai Krishna Kumaraswamy and myself. We both work with the micro and small enterprise finance team at CGAP. And you might have seen one of the focus notes that we both co-authored, specifically looking at how segmentation for micro and small enterprises can help fintechs and financial service providers serve them better. A quick introduction to our speakers. We have 4 of our speakers online already, and one will be joining us shortly. So we've got Timothy Ogden, who is the Managing Director for the Financial Access Initiative and the Managing Director of the Small Firm Diaries project. We have Parbu, who is the Managing Partner for Axion Venture Labs. Ami has been doing quite a lot of work with fintechs, specifically looking at the inclusion space. We will shortly be joined by Evelyn Wangari, who is the head for financial services at Copia Global. We're also joined by Shashidhar Thumuluri, who is the Managing Director and CEO of Subke, based in India. And finally, Greta Bull, who is a director at the Bill and Melinda Gates Foundation, specifically working on financial inclusion and gender initiatives. Just a quick run through the agenda. My colleague Sai and I will do some introductions and the housekeeping, and then Sai will talk you through a little bit about the segmentation work that we've been doing at CGAP, and we'll summarize some of our findings from our primary research. And then we'll jump straight into panelists' presentations and Q&A. We're running this session a little bit differently than we have before. So we're using some sort of a round robin style discussion. So we will give each panelist 5 minutes to make their remarks. This will be followed by audience Q&A for up to 5 minutes. And then finally, we might ask one of the other panelists to comment on the topic that the primary panelist is speaking about. And the idea would be just to give you a slightly different perspective, either from a provider, a donor, a funder, or from a research perspective. We will ask that all the Q&As from the audience be added into the chat box, and Sai and I will pull up the questions once each of the panelists has finished speaking. And if anyone has any additional questions for those panelists, we will try to get to them later on in the session. Just a few logistics. This is an audio broadcast. All of the attendee microphones will remain muted through the entire session. As I mentioned already, please make sure to put all of your questions in the chat box on the right-hand side of the WebEx session, and submit your questions at any time during the webinar presentation. But do keep in mind that we will be picking up questions related to a specific topic as soon as that panelist is done speaking. So do try to limit your questions as much as possible to what the current panelist is speaking about. And then if you have any additional questions, we can try to pick them up later in the session. And then please make sure that you pick all participants at the bottom of the chat box to ensure that we can all see the questions that you're putting in there. The webinar is being recorded and it can be emailed to all the attendees and the registrants upon request. I think with that, I'll hand over to my colleague Sai.
Thanks, Swati. I'm acutely aware of how this is a topic close to everybody's hearts, and you're all very familiar with both MSE financing and segmentation. And like you, I can't wait to hear from our panelists either. But let me just spend 3 to 4 minutes setting up today's conversation to underscore why this is such an important topic. Primarily, there are 3 statistics that I want to draw our attention to and dwell upon to frame the discussion. First is that there are nearly 500 million micro and small enterprises in emerging markets. Second, they contribute to as much as half of net job creation, primarily through self-employment, even if not wage jobs or paid employment for others. What MSEs lack in terms of size and growth prospects, they certainly make up in terms of sheer volume and their contribution to emerging economies. The third is that they're extremely credit hungry. Now, there are several estimates of the global demand for credit from micro and small enterprises, and they vary wildly depending on who's counted and who's not. CGAP's own estimate puts it around $5 trillion. But the bigger message is that this is a very, very large problem that confronts the development community today that needs very innovative and pressing solutions. Now, part of the problem has also been the temptation for the financial inclusion community stakeholders to look at MSEs as one monolithic universe. We have all seen financial products on the market that target MSEs as if they were one customer segment. We have also seen well-intentioned policies by governments and policymakers that attempt to develop the MSME sector as if they were one monolithic sector. But in reality, the universe of MSEs is a very, very overwhelmingly rich and diverse and varied set of firms, each with different ambitions, experiences, capabilities, and desires. CGAP, as part of its own investigation to understand how we can better serve MSEs in an increasingly digital ecosystem, undertook primary research with nearly 400 MSEs in India, Kenya, and Peru. And using this primary research, we applied a segmentation framework of 5 dimensions: that of the size of the MSE, focusing on firms less than 5 employees, 5 to 19 employees, and more than 19 employees. We did a sectoral segmentation, which looked at the retail sector, the low skills manufacturing sector, and the transport sector. We also used the framework of mindset to arrive at the difference between firms that have a subsistence orientation and high growth orientation. And finally, we also looked at the growth stage. When it comes to gender, we really tried to go beyond the binaries of male-owned and female-owned enterprises, but given the prevalent norms in the countries that we work with and the lack of reliable data, unfortunately, it was a binary segmentation. Now, what we also learned was none of these segments are final in and of themselves. There are lots of subsegments within each of these segments, but it was a good starting point to ring-fence CGAP's learning agenda and inform our pilots with innovative fintech providers targeting micro and small enterprises. Now, let me walk you through one illustrative example of how a segmentation framework helped CGAP. This is very high level and very illustrative. But when we talk about sectoral segmentation, let's take the example of the retail sector. Here we found that it has a very large concentration of subsistent enterprises, mostly owned by women. But the kind of products available in the market did not meet the unique needs and barriers that women face. So it's important that products that target the retail sector MSEs are also gender responsive because of the kind of demographic that's concentrated in the sector. Now, let us also consider the manufacturing sector. We found that the life cycle capital needs of the manufacturing sector MSEs require large ticket size loans. So even though the market had digital credit products, the size of the loans offered did not meet the needs of the MSEs in this particular sector. And therefore, there was low take-up and naturally low impact of such financing. And finally, when we talk about sectoral characteristics, a business in the transport sector tends to be overwhelmingly cash-based because of the nature of expenses and revenues. And that translates into lower readiness and capabilities of firms in the sector to digitize not only their payments, but also their operations. And this translates into their attitudes around digital credit as well. Now, my intention is not to walk you through each line of this table, but the larger point that we want to impress upon you is that there is a need to look at micro and small enterprises with a lot more granularity that respects the diversity that the segment brings in. Now, that said, segmentation is not as easy as we hope it is because there are several challenges, from the lack of availability of data to organizational incentives. Very often providers and funders do not know where to begin, what kind of frameworks to apply. And this is exactly what we will be unpacking with our panelists today. So before I turn to our panelists, I would love to share the story of Zainab, who was one of the 400 entrepreneurs we met in our primary research that underscores some of the complexity of the lives of MSE owners. It's just a short video, and then we will turn to our panelists.
By name, I'm called Zainab Ali. Initially, I was a travel agent by profession. You cannot be employed and get rich. So I had to look for other areas where I could get money because my family depends on me. We lost our father at a very tender age. My mother remarried. She lost her husband again when the kids were very young. So basically, we were struggling. I finished high school. I started working as a sales girl. I took myself to college. From the money that I was getting from employment, I started something on the side. I decided to become something like an entrepreneur. Running my own business was a dream that I've always dreamt of. You become a boss of your own. If other people could be bosses, why not me? I have two different businesses that I'm doing. I'm running a printing farm, t-shirts, mug printing, signage, and at the same time I have a fast food, fries, chicken wrap, burgers, fresh juice. I sell sodas here in Kibera. A company like Coca-Cola or a Pepsi, they were giving a fridge for free as long as you stock. So there are some things that I bought on the savings that I had, and there are some things that I have for free from companies. I've always thought of creating employment for other youth in my neighborhood. In Kibera, early in the morning, they'll just sit in a bench, and in the evening, you'll find them in the same bench. So I thought of, is there something that I could do to at least create employment for those youth? Because you'll find that maybe their story is similar like mine. They don't have anyone they can rely on. So for me, when I opened this printing farm, I said I would at least employ 4 to 5 boys who will be doing graphic design. Boys like graphics. So I coached them. If you go to YouTube, there are tutorials. So they are actually now getting money from me because now printing of t-shirts is the in thing here in Kibra. It was not an easy journey. The first 6 months, I really went a lot. There was no restaurant that was selling burgers or chicken wraps. So you will find that after the 6 months, it started picking up. So I started introducing juices, I started introducing things like ice cream. 9 years later, and I'm still running the same business. Why if not for COVID, maybe I would have expanded. Because of COVID, we had to look for a smaller space. With this current situation and the lockdown, the basic needs is what now we are prioritizing. Right now, things are very, very, very tough. We can't afford a health cover. My husband is sick. He has colon cancer. I feel like I have so many responsibilities on my back. As a woman, you have so many things on your plate. You have to either breadwinner. People are looking up to you. Then we must not forget that we need capital as well. I don't believe in going to the bank for loans. Banks sometimes can be very, very tricky. There's some hidden costs and the interest is high. But there's one place where I normally used to get money from, the National Government Fund. They would lend you money at no interest rate, and they would give you a 6-month grace period. We try as much as possible to avoid banking charges. We look at that as our profit. If, for example, the amount is not so much, we pay cash. If I do bank transfer, it is the bank that is benefiting. Most of the customers have put money into their funds, but then it is not beneficial to me. Yes, it is easy because clients will pay through their funds, but when we want to use that money, we are deducted. So it was a gain to the service provider and a loss to me. Instead, I became an agent for Safaricom. I pass on the charges, so they will withdraw from my agent number. Now Safaricom pays me. Right now, I'm planning on getting into corporate. Now is a bit difficult because most of the corporates are shutting down because of COVID. When things go back to normal, of course, business will boom. I would really want to go online because if I go online, I'll reach out to many people. Money is good. Without money, your hands are tied. With money, I can acquire a house. Right now, I'm living in a rented place. It is tiresome. It is so frustrating. Personally, I would like to become rich, at least moderate. We have capacity to do so much, but our hands are tied financially. If given a chance, at least we could turn our businesses into a reality. We have a vision, maybe in future, if, for example, I, as Zainab, am able to create employment for the upcoming youth to at least realize their worth, then we could all change how people look at us and make people see Kibra differently.
All right. So I hope you shared the inspiration that I had about the importance of small businesses in the lives of people and livelihoods of people from low-income communities. and the transformative potential for finance, and how there are barriers in their journey to seek finance. Now, I'm going to open the session up and ask a series of questions to our panelists. Request the audience to keep the questions coming in the chat box. We'll open up for Q&A after each panelist makes their response. Tim, I would love to begin with you. And the big picture question I have for you is, does firm size matter? There are so many taxonomies, new categories that we're seeing, from very small enterprises, nanopreneurs, solopreneurs. So where is the meaningful analytical cutoff? What are the numbers that we should worry about? And how much do these segments really inform either the products in the market or support mechanisms that funders develop?
Thanks, Sai, and thanks for having me here. Let me start just by saying, as Sai mentioned at the beginning, the FAI is currently running a project called the Small Firm Diaries that you can find more about at the smallfirmdiaries.org, where we're doing year-long financial diaries of firms between 1 and 20 employees in 7 different countries. And in part specifically to understand this, because we come from the microfinance realm. And the idea of microfinance always from the beginning was you make these small loans, people start businesses, and they're going to grow. And we've found over the last 30 years that, well, certainly there are some firms, the vast majority of firms that the microfinance sector has served have not grown. And so we began the Small Firm Diaries to try and understand not just, well, how should we change the microfinance product to enable growth, but to really answer that question, we have to understand what's going on with the firms that have grown, that are a little bit bigger. And I was heavily influenced by a book that I'm gonna hold up here, and it's called The Illusions of Entrepreneurship by a scholar named Scott Shane. And this is a book exclusively about the United States, but it's about how the rhetoric around entrepreneurship in the United States is wildly distorted from the realities in the data. That a lot of what people talk about what entrepreneurship is and who's an entrepreneur and what the entrepreneurial journey is like, isn't really reflected. It's sort of what we would like to believe the world is like. And I think a lot of that's in this book, I recommend it to everyone, not because you really need to know necessarily about the United States entrepreneurial ecosystem, but I think if you look at this book, you'll recognize a lot of the same challenges that we have globally. Is what are the segments? What is this really like? When we say entrepreneurship, what do we really mean? And what are the different ways of viewing this that really matter? And there's a big problem of data that comes along with this. So we started the Small Firm Diaries on this idea from the more developed markets, that the single most significant differentiator between businesses is whether they are employer firms or not. And we see in data from developed countries that the majority of firms, and here we establish, meaning organizations in developed countries that have a registration as a firm, the majority of firms are non-employer firms, and the majority of non-employer firms never become employer firms. Only firms that start with employees ever have employees is another way to think about that. And so when we designed the Small Firm Diaries, it was in this idea, okay, so what are the firms that are already employing people? What do they look like? So we think there is a very meaningful cutoff between 0 and 1. And that 1 is a non-family employee. And of course, we're talking about lots of low-income situations here. And so we also have to have a conversation ultimately about what an employee is. But here we're just talking about someone outside the family who is paid a wage. It can be conditional, it can be piece rate, it can be any number of mechanisms, but you're paying cash money to a person outside the family to work in the business. And then we theorize that there's sort of a next step up for any of those firms where they go from an owner manager to having people who are hired just to be managers. And that, from the developed world literature, is another big distinction between firms. And so we designed the Small Firm Diaries on this idea of 1 to 20 employees, not because we have a firm idea of that, but conceptually, you can't have more than 20 employees without hiring someone whose job it is to only manage employees. And so we think that is a really, really meaningful distinction between firms, and that there isn't a lot of value in what we see in a lot of data sets around the world, which is 0 to 5 or 0 to 10. And in those groupings, typically 80 to 90% are 0. And those firms are utterly different from the firms that have just added 1 employee. And so, my greatest hope in the next few years is that we end the definition of MSME as 0 plus anything else. There's 0, and then there's something else. And then the second distinction I think that really is important for us as we think about this is something that you hinted at around some sectoral related things. The retail sector, and in retail I include food service, is a different industry than most of the others. And I think there is sort of a useful way of saying retail and food and everything else. And a lot of that has to do with, as was shown in the slide that you showed, Sai, is the reason so many firms are retail and food service firms is they don't require startup capital. It's really easy to start basically from resources. Most of the other firms require a initial investment, but those firms aren't turning to financial services for that initial investment. They're building it up themselves. When they need financial services is on an ongoing basis to manage liquidity primarily. And I think that is another way of really thinking about segmentation is who needs what types of liquidity, who needs what types of working capital, what is the cash conversion cycle, meaning from when I spend money, how quickly do I get money back? And that can dictate a lot of design of financial services and what the financing needs of firms are. Do they need 30-day loans? Do they need 90-day loans? Do they need 120-day loans? Or do they need multi-year loans? When you're buying equipment, you want long-term loans, but when you're managing the day-to-day, you need short-term liquidity financing, and thinking through a separation of firms, a segmentation of firms around their liquidity needs and what the structure of those liquidity needs, I think is a big important way to drive segmentation.
Thanks, Tim. And I wonder if it makes sense to bring in Greta here, because she's been thinking about this in her work as well. Greta, would you love to add anything?
Yeah, so much to react to here, and I don't want to get ahead of my own but I guess mostly to wholeheartedly agree with what Tim is saying, and I think for our sins of making this point in a prior conversation with CGAP, we're here. And just to say where I'm coming from is a little bit different. So my role at the Gates Foundation is really focused on for women's livelihoods, right? And so I think actually we stretch the boundaries of MSME segmentation even further. So first of all, wholeheartedly agree that MSMEs are ludicrous as a segment. And to ask ourselves why people aren't going from nano to micro to small, we're asking firms to take these huge leaps to begin with. So I mean, to try to trace a pathway from, 1 to 20 to 100, I mean, it just doesn't make any sense. I think the nuance is in the subsegments there, and we don't talk about those subsegments. So first of all, wholeheartedly agree. I would even put something before the zero entrepreneurs, right? So the way we're starting to think about it is segments that cover things like subsistence borrowers, like in poor women, subsistence borrowers. So that's like the VSLAs and the self-help groups. And I'll talk about that in a minute because there's a lot of interesting work going on in that space. Then you have your kind of nano entrepreneurs, and 100% agree that the difference between 0 and 1 employee is huge, but there are lots of like variations on 1 employee, half employee, a quarter employee, your friend down the street. And so, in the informal sector, there's a lot of informality, no surprises. And then, as you get more formal, it becomes a little bit different. The needs of those borrowers are going to be completely different, as Tim points out. And the providers who are able to affordably serve those segments are going to be really different too. And I think we've, for years, kind of lumped everything together, said, hey, look, we have this hammer, we're going to hit this MSME segment, and we're going to have impact. And lo and behold, we don't have impact because we're not actually asking the right questions. And so, I think we do need to start resetting the conversation about having meaningful segmentations that reflect the poor and how they engage with credit, particularly as a product, and then kind of translating that into a conversation about, well, how do we serve those segments, and what should we be expecting? At the subsistence level, it's either income diversification or resilience, frankly. If you're a nano entrepreneur, it's a very different use of credit. And so I think, bottom line, agreeing with Tim, we need to get a whole lot more nuanced about how we talk about segments, because I think part of the reason we've been challenged in the past is that we're talking about 95% of the enterprises in a country as though they were the same thing.
Makes sense, Greta. And, sort of reconciling both your points, I do have a follow-up question on measurement for Tim. Assuming we get to the future where the segments look like non-employer and employer firms, we know that these firms live and operate in the spectrum of formality, most of them quasi-formal. How do we sort of get to measuring who's an employee, how many employees they have? Have you thought about some of those things?
So it is a particularly challenging thing, because again, sort of our framework, our language around employee and contractor and all sorts of things often comes as borrowed from sort of other contexts. One of the things we see in the small firm diaries data is that employment is very tenuous. So we see the people who are paid changing in two ways. One is that the amount a person is paid month by month changes a lot, but whether any particular individual is employed in this firm changes a lot. And so more than half of the people that we count who get paid are paid by a firm in less than 6 months of a year. And so we see people coming and going. An employee a firm may be paying 3 different people at any given time, but though that will be 15 people over the course of 12 months, just only 3 individuals at a time. I think that speaks a lot to the structure of these markets, where it's very difficult. The firms are facing a lot of volatility, and so they don't have a lot of tools to provide any steadiness onto their employees. So the volatility that they face then gets immediately passed down to the employees. Now, I would love for there to be an easy definition of this. For now, I think the best that we can do is looking at, is this a person outside the family who's been being paid cash for work? And then, beyond that, we can potentially do some future segmentation, particularly as you move up the scale. But the ability to turn workers into employees, the steady employees, has a lot to do with the ability of the firms to generate stability for themselves. Until they can generate their own stable revenue flows, they can't generate stable jobs.
Sounds like a good starting point, although we know measurement's really a tenuous topic and you've all thought about it deeply. So I'm going to hand it over to Swati to take us on from here, and just a PSA to the audience to keep get the questions coming, but please make sure you address it to everybody. Thank you.
Sai, we have one more question in the chat. I don't know if you want to pick that up before we move on.
Sure. We do have a question. Sometimes segmentation by number could be very confusing. Many MSEs in the digital space are small in size, about 5 to 6 employees, but they're pretty sophisticated. Should we also not look at the segments from the type of industry and intensity of the issues? Tim, do you want to respond to that? So,
I think there's always an argument for deeper segmentation. I think some of the challenge that we have is, we all have limited resources, right? We can't develop specific programs for every piece of this. So there absolutely is a question of the level of sophistication of the owner and both the markets that they are working in, the sophistication of their products, the level of capital and human capital in the business. Small firm diaries, the work that we're doing is really focused on the step just above the micro. So we're exclusively looking in low income neighborhoods in basically low income and middle income countries. And so, we excluded the entrepreneur from Colombia who came and got a degree in the United States and is back in Colombia starting up a firm with 4 or 5 employees. I think those are really important. They're really important for the development of Colombia. They're really important for the jobs that they create because of the people that they hire. And so I think, yes, it is important to recognize, what are some levels of sophistication? What are people able to access? But we also have to then narrow in some and say, we're creating segments that are big enough that we can actually sort of reasonably serve.
Thanks, Tim. Swati, take us away.
Thank you. Thanks, Tim and Greta. Ami, if it's okay, we'll maybe move on to you and talk a little bit about the work that you've done. So as Sai mentioned, when we looked at the segmentation, one of the aspects that we found very interesting was around mindsets. And we found that mindsets not only impact the growth of the enterprise, but also the manner in which they access financial services and how frequently they access financial services. I know that Axion had done some work in the past around psychometric testing. I guess the question is that relevant anymore, given that we're looking at data-led embedded finance models? And also, if we take away some of that, then what does that mean in terms of building personal relationships with the customers and understanding their propensity to grow and their willingness to grow, and then building that into credit decisioning? Your thought from your perspective from the provider side and the fintechs that you invest in would be really helpful.
Sure, happy to, and thanks so much for having me. Yeah, as Swati mentioned, I'm Ami Parbu, one of the managing partners of Axion Venture Lab. We have been investing in early stage inclusive fintech companies globally for the last decade. So made over 60 investments, all in kind of pre-Series A early stage companies. And the focus has largely been on the needs of small businesses. So a real focus on how fintech companies can reach small businesses for all of the reasons I, was in your presentation in the beginning. That the needs are credit, but it's also digital tools. It's kind of B2B marketplaces and embedded finance increasingly, but even insurance. So, we cover kind of the broad range of what small businesses need. And first of all, I just echo Tim and Greta in I'm very glad for a more nuanced approach for small business and MSME segmentation. It's spot on that it's been too long, in our broader financial inclusion ecosystem that we talk about and treat small businesses as monoliths, which is actually quite different than how providers have always thought about small businesses. I mean, all of our companies, and we've seen over the years, companies are segmenting customers and thinking about, once you crack the surface of saying we're a small business finance company, there are all kinds of really interesting learning. So we work with our companies often to do these kind of segmentation exercises of their portfolios. And you see things, one company may explicitly say, we don't look at construction. One fintech company reaching small businesses may explicitly say, we are focusing on construction. They might have different renewal habits that they see that differ by mindset. They might have different patterns related to gender. All of these have implications on the value proposition that these providers are offering, as well as their go-to-market strategy. But the monolithic nature, when you break it down, I mean, again, we've seen how this extends beyond, how products are structured, whether it's a 6-month or a 12-month loan versus revolving credit products or factoring, as well as how customers are targeted, as I said. The question of mindset is a good one. And you're right. Yes, over the years, we've seen in fintech a real interest in alternative credit scoring, anything that essentially is leveraging data to better understand, ability to pay and willingness to pay of a customer. And we've been very open to exploring those type of models. We've seen them either in kind of standalone alternative credit scoring psychometric companies that are partnering with providers and providing that kind of alternative credit scoring, or they're kind of embedded into providers in the way that they're developing new underwriting models. I think ultimately our learning, and from our perspective, is we've seen psychometrics is really hard to do. It's become far less prevalent and honestly very difficult to scale. So whether that's because of the data collection and gathering that's required in order to feed the models for a psychometric model, or just in general the change management. If you're a microfinance institution or a fintech company, you've been doing underwriting a certain way for a very long time, to be now kind of convincing everyone from the center office down to a loan officer of collecting different forms of data and leveraging that is challenging. So, you know, we've kind of seen that kind of fade a little bit in favor in the fintech space. But that said, I think there are elements of this mindset segmentation in the fintech providers that we work with in various different forms. I think, first of all, we're actually seeing, you know, the verifiable data that can in some ways be proxies for growth orientation. And that in our minds is far more, you know, scalable. It's not really relying on kind of self-reported data. This could be anything from, you know, retailer sales, the invoices that a contractor has with a builder that they're working with. It could be the percent of consumption of an allocated credit line that gives you some sense, again, of, you know, how much capital they're requiring as a business, what that growth orientation might be. It could even be, you know, when if folks are waiting until the last day to pay for, you know, a term loan, or if they're bounce backs on kind of e-withdrawal mandates. Those type of things all can give you some sense of the kind of discipline of a small business owner, the likeliness of kind of defaults into the future. So I think there are elements of that mindset that play in for providers, but just in a very different form than, you know, a psychometric analysis these days. The last point I would make related to mindset is that I don't think by any means that it's a requirement to see growth orientation in order to provide access to credit. And I think the focus note that CGAP has put out does a good job of laying out, the opportunities for both kind of cautious entrepreneurs and the more growth-oriented entrepreneurs. And that kind of, you know, aligns with a few of the things we're really excited about. So many of the challenges for small businesses doesn't actually come from, you know, needing capital for an initial expenditure and equipment. It is increasingly to help deal with mismatches in cash flows. And Tim highlighted this as well. You know, if you're a contractor and you've got a project with a builder lined up, as you know, but then you need to go out and hire a team, or you need to go buy the materials. How do you do that when you're waiting 60 days to get paid from that builder? Or if you're a retailer and, you know, you need to buy inventory, but, you know, you just need that one extra week of essentially extended payment terms. Those kind of examples, there are tons of them where it's really, again, not about needing to help a small business get that next shop or to buy that additional truck, but it's really to help with these mismatches of cash flows. And I think that's one area we're really excited about, is the innovations around kind of new credit products that align with that. Related to that is really excitement for models that sit in supply chains. So how much of the challenges that we are trying to solve with understanding an entrepreneur's mindset actually are solved if we can just create closed loop credit products. Where, because, you know, we're tied to corporate anchors who have a series of suppliers they work with, you get access to those small business suppliers, but also know that you'll get repaid through that anchor corporate. Again, it just simplifies a lot of that credit decision making from what we've seen. And then you mentioned embedded finance. I mean, I think this is where we're really excited about how you can create more contextualized products that sit within a platform or a set of digital tools that a small business may already be using. We are increasingly taking, actually to this point of segmentation, a very verticalized approach to small business, or to embedded finance for small businesses. So we're looking at, you know, fintech companies reaching truckers in a certain market and building embedded finance solutions on top of digital tools for that segment. I think it's just a richness and a more relevant customer experience when you create those kind of tools.
Thank you. They're very, very interesting. It's something that we grapple with as well, but also getting providers to understand that because you have different kinds of mindsets, they all should be getting credit, just, you know, thinking about how you price that credit differently or how you structure the credit differently.
Right.
Shashi,
or you communicated. I think so much of our learnings has actually been, you know, oftentimes we feel the need to communicate a credit product as a credit product, but if it's extended payment terms, or it's, you know, that makes quite a difference for a customer.
Yeah, there is still a mindset block towards taking credit and being in debt. Shashi, I wonder if you might have a few thoughts to add from your perspective as a provider as well on how you integrate mindset into your thinking.
Thank you, Swati. Thanks for this opportunity. Yeah, so, you know, as I think through this conversation, you know, I'm hearing various perspectives, and I think all are great. thoughts. So one way to look from a provider's perspective is when we look at the market and try and see how do we deliver products for a certain market. MSME seems like an ocean, right? It's everything and anything. 90% of enterprises in developing countries, India being the case, are all bundled under this broad block called MSME. So I think that itself is not a segment in any way or market. It's a market, right? So as I provide products to customers, I need to know who is the customer, and knowing that customer means segmentation, right? Slicing that market in the direction that we want to deliver. So to the point that everyone is making, one is the size, but I think the size aspect, within the size, there are multiple slices, right? The sector comes into picture, the gender comes into picture, the entrepreneurial stage comes into picture. But very interestingly, if you go too much in the bottom, actually these things don't really matter. What matters is, a very general cash flow management product. And then as you go up the ladder, the specialization comes in. So I think as we segment the market, it is also important to see how important it is to segment at what level of the market. Otherwise, we get into too much of a nuance, and sometimes it becomes very difficult for the provider to design products that are very specific to a particular segment, which is not necessarily required at a layer that you are operating. For example, we operate in a nano or a micro segment where most of the product needs are cash flow needs. They are very working capital kind of product needs, which really do not differ much from sector to sector, but they differ from the way that people perceive a customer, like gender, for example, is a very important aspect. Digital behavior is another important aspect. So I think those are some areas that we try and focus on when we segment our customers. On the mindsets, the point that I wanted to make is the provider mindset, to me, is the biggest roadblock or biggest aspect that needs to be addressed all the way from top to bottom, right? All the way at the board level for the organization. To be willing to see the market they're serving from a segmentation perspective. And of course, it's in the benefit of the business to do that, because the better you serve your customer, the better you know your customer, the better you serve the customer, to the last guy who is actually interacting with the customer. I think for them, the mindset challenge is much bigger. For them, they have been serving this market in a certain way. And how do you make them realize that, there is nuances associated with that customer? And then, there is something that they need to do to understand that customer better so that the right processes can be designed. Because product innovations are more process innovations in my mind. They're not really much to do with product. Product is credit at the end of the day, but who is the customer based on which you deal with that customer, and that's how you design your process. And that is actually delivered by the person on the last mile. So we really deal with a lot of the mindset issues from the delivery perspective so that, it is rightly aligned with the customer needs. And at the end of the day, it kind of makes sense in what you're trying to do. So that aspect, I can talk a little bit more in terms of how you manage that. But typically, for me, mindset is the biggest, area of intervention that one should look at if one has to really think about markets from that perspective. Thank you.
Thanks, Jesse. Really helpful. Ami, I have a couple follow-up questions from Tim and others. So Tim is asking, have you seen anything working in terms of what you would call alternative psychometrics? Getting information from other participants in the market who have knowledge, like customers, suppliers, competitors, as they would tend to know a little bit more about who is a good credit risk and who's bad.
Yeah, I mean, it really depends on how you define information. And for us, where we are seeing is essentially data that's coming in from those supply chain players. So again, if you're a distributor who's selling, inventory to small retailers, how do you get that transaction data from those distributors? And that tells you a lot about, okay, what does the purchasing, the history look like for a small retailer? And that's really, really useful. In the traditional way we've thought about psychometrics of it being around a willingness to pay, I think that's just a lot harder to scale, even if it's coming from those alternative channels. But again, if it's hard data around transactions, that becomes really powerful. And in some ways is this proxy for a mindset.
And then we have a question from Govinda asking about wanting to know more about the psychometric scoring and how do we assess using this tool. But from what I understood from your comments earlier on, that is something that, and I know we were looking at it as well about 10 years ago, and the tool progressed and grew, but it's not something that really picked up and was easily scalable. Is that right? Would you say that psychometrics as a concept is not as prominent as it used to be a few years ago?
Yeah, I mean, look, I'd love to be proven wrong, and I think there's still folks out there working on this and refining models and trying to figure out how to make it scale. Again, in our experience, it has been hard to scale, and honestly, I think some of the data is still out in terms of the effectiveness of it actually proving out whether or not someone is a good credit risk. We've had portfolio companies who have sort of taken a longitudinal view, come back 5 years after implementing something in the psychometric space, and it not actually effectively, showing anything around that good credit risk. But again, folks are still working on that, and time will tell if something new comes out.
And then Greta has a question, absolute last, because I know we need to move on, but how available is that data and how many people are in the value chain that offer that level of visibility? This relates to some of the segments as well. More highly digitized and transacting digitally in supply chains indicates higher income segments. I know from our experience, I know that that's not necessarily true, because we are seeing micro retailers, really, really small mom and pop shops that are getting plugged into the digital value chains, and there's a lot more data available about the inventory that they need in their sales, and that is helping, service some of those proxies. But what's your experience with this?
Yeah, exactly. I mean, it's growing rapidly, and I think this is the future that we're excited about. Is how do you couple digital tools, which will help a small business on that digitization journey, with also then these financial products. But yeah, I mean, even today in the current state, whether it's leveraging certain digital tools that are already available, not just to retailers, but in these other segments. There are buyers in agriculture who have data around the farmers that they, are their suppliers. There are big corporate anchors who are working with, suppliers. There are multiple of these chains in various different segments that increasingly do have good data trails, which can be leveraged for this.
Great. I'm going to stop and ask Sai to move us along, and then we'll come back. I know we have a couple of questions on the broader issue of segmentation, but maybe we'll take those at the end of the session and open it up to all the panelists. Sai, over to you.
Thanks, Swati. 75 minutes is never enough to discuss such a fascinating topic. Greta, I want to turn to you and shift us a little bit to talk about, are there customers for whom market-based approaches don't work? Yeah. And what are the alternative ways of providing access to such customers? And have you thought about what are some enabling environment interventions we could make, either policy changes or the provision of non-financial services? What are some ecosystem-wide efforts we can do to graduate these segments into being able to be served by market-based approaches?
Yeah, thank you. And thanks for the opportunity to be here. And I'd love to dig in on this data point, because I think data is going to be really fundamental to all of this stuff. But I think right now, the short answer to your question is yes, there are segments out there. And I think we need to understand better how big they are, of people who can't be reached with commercial means. And we're trying to wrap our heads around how big some of these segments are and how many of them are digitized, and what we can do to kind of deliver better. So I talked. Well, let me back up. I mean, we're very focused on, and I think it's always worth reminding ourselves that, like, at least this industry came about because we were trying to serve the poor, right? And the poor is a much bigger segment than micro enterprises. And so that's one reason I think we do need to be a little bit more thoughtful about how we segment the poor and what their intersection is with credit, right? So I talked earlier about subsistence entrepreneurs, nano entrepreneurs, so that even it comes in before you get to micro and subsegments there. And so where we're focused right now is very much in that lower income segment of people who don't probably have a micro enterprise, or they have a nano enterprise, or they want to have a nano enterprise, and what are solutions that might get them there. And we have a lot of work going on with kind of hybrid models, let's call it, of reaching those entrepreneurs. So if I think about subsistence entrepreneurs, a lot of these are women who are at home, they can't leave their home, but they might have a separate income stream, and they might need credit to do that. They might need credit because somebody in the family fell ill and they need to deal with that. And so there are lots of different ways of looking at credit as a tool. And I think I'm speaking of it more as a resilience tool and as an income diversification tool, let's call it. And then shifting into a nano enterprise where you may have fixed premises, you may have yourself working there and occasional people that you employ, but that doesn't really show up in some of the diaries work that Tim was talking about and some of the work that others are doing. They're not very likely to be digitized, right? And so you may not have that kind of visibility. So the question is, how do you create that kind of visibility, and what's the step ladder to get people on? So we do a lot of work with the National Rural Livelihoods Mission in India, and India has done really interesting things on credit availability that we don't always talk about. So we spend a lot of time talking about the India stack, and that's all really amazing stuff. It's digitizing, it's getting payments out there, it's getting visibility on those data trails. What we don't talk about so often is the fact that that whole edifice is kind of based on the fact that people have bank accounts. They have the right to a bank account in a state-owned bank. So that's kind of foundational, whereas you have to have a mobile wallet to do that in other places. But there's also a ton of work that India's done to drive credit through that ecosystem. So through its priority sector lending mandate, you get credit going to self-help groups, you get credit going to micro enterprises, and this flow of liquidity is creating a lot of innovation. And that's what's driving some of the fintech innovation in India, but also, differentiation of different kinds of providers in the microcredit space. But it's also getting a lot of credit to self-help group women in a pretty structured way. And what you're seeing emerge are things like little credit unions that sit in cluster level federations that are serving those women who would just not have a hope of getting credit. And so what you see, and we want to do more work on this, is that, these women are diversifying their incomes and then they're getting enough pulled together to have a little shop. So I visited a woman who has basically a printing shop, and she employs a couple of people casually in Bihar. And there are lots of these kinds of stories. And so, people mushroom farming and being agripreneurs. And so the Indian government's driving a lot of change through pushing this liquidity into the market. And then having the digital data trails and the market infrastructure to be able to actually have visibility. We're working on developing a pool of data that would document the performance of women in self-help groups, because we have Aadhaar. We can sort of both document how well groups are performing, but how well individuals are performing within those groups. And then the question is, how do you get them on a ladder to nano and maybe to micro so that you have that level of growth? And in the current segmentation that we do, that pathway wouldn't even show up, because you're not going from our giant category of micro to our giant category of small. And I think a more nuanced kind of understanding of what those segments are would help us tell that story a little bit better, because the vast majority of women in emerging markets are going to be in that very lower income segment. And how do we kind of move them up to where we could even measure them as an enterprise that Tim's looking at? And so I think there's a really important role for government in that. The other example I would give, of course, is BRAC, where BRAC has multiple capital interventions going from ultra-poor graduation, which has a lot of impact, but it's expensive, and it has a lot of different intervention types, through to cash transfers, asset transfers, and then credit. And they do that in every market that they're in. And so when we talk about capital in my team at the Gates Foundation, we also have a financial services for the poor team that are thinking about this in a really different way. But when we talk about capital, we mean a capital spectrum from everything from ultra-poor graduation through grant models to returnable models, and what are some hybrid ways of doing it in between. So for example, if you look at the way self-help groups work in India, and now we're experimenting with this in Kenya, it's not just about what that group can scrape together on its own. They get a capitalization grant, and then that becomes part of the corpus, and that, there are requirements to put money in, savings and credit comes out the other side. And then, they start developing a history, and government banks can lend to those groups, right? And so it's really about trying to create a bit of a flywheel at the bottom end of the spectrum so you can move people up eventually. And at some level, that might have to be grant funding. At some level, there's a case to be made for moving people into credit, because capital is not limited, or it is limited, it's not unlimited. So we're trying to explore what that pathway looks for the mass market poor who maybe aren't getting funding or credit from fintechs or other kinds of organizations. And it's not going to be all of them, and not everybody should get credit, right? But how do you find a way to target, that say 10 or 20% of people in that space who actually could grow a business and employ people? So I think it gets a little bit more nuanced at the bottom end of the market. We need to think about what role of government is. I think in the microcredit space, we've become so focused on commercial viability that we're forgetting about the impact thing. And that's what the impact evidence is telling us, right? You're not having any impact with credit. So how do we start thinking about matching needs with products so that we start having that impact? I think that's a little bit what we're aiming to get at. Let me stop there.
Thanks, Greta. And I wonder if it's worth bringing in Ami to chime in on this, particularly around, as an investor, what kind of models are you seeing targeting these kind of customer segments that are traditionally hard to reach using a market-based approach entirely?
Yeah, no, I think these are all really good points. And the first thing I would say is you're absolutely right. I mean, we are, digital financial services and fintech isn't going to reach everyone, either because of comfort with digitization or because of the risk, the risk profiles that these fintech companies are willing to take. And so I completely hear the point and agree there's a need for a broader thinking of who are the providers who can meet the needs of these customers. I think there's also a really interesting piece around graduation. We see within fintech companies themselves, providers are thinking about graduating from a small loan or from an initial offering. It might be more from a savings perspective or from an account to then credit and other, but there's maybe even a step before that of saying if there's other providers who are, building initial, how can we just make sure they're then graduating to other credit products and a broader marketplace of providers. So I think that's one piece of it for sure that we're excited about. And then I think what we're also seeing is that these embedded solutions, these verticalized kind of models, in some ways just better help target needs of, for example, smallholder farmers who are increasingly women and can better reach them, meet them, know how to get in front of them, and then communicate a value proposition and deliver a product, a financial product that's more relevant to them. So just another reason why we, as an investor, are excited about verticalized plays that could potentially go down to even lower segments than we're traditionally seeing in the fintech space.
Greta, you mentioned your work on the National Rural Livelihoods Mission. So I wonder if across countries, have you thought about, in terms of levers of support for MSME financing, is necessarily one more powerful than the other? So should we first begin with a policy intervention and then sort of evangelize business models? Is there like a sequence that you think works best from your portfolio work?
There's no magical sequence, and different countries are in different places. But I do think we need to kind of shift the debate, both segments on the demand side, but also provider segments. Like for a bank, it's going to be really hard to reach super far down market. The unit economics just don't work. And that will be true of fintechs in some way because the expectations of their investors will not probably allow that. And so I think we need to have different kinds of providers matching different kinds of needs. And then we need to have this data visibility, as Amy was saying, to be able to think about whether we can graduate. I don't think we have really very good evidence saying whether people are making that graduation journey. Lots of anecdotal evidence, but I think it would be, and this whole segmentation point is to be able to track that and see. But I do think there are things that matter. I think the availability of low-cost capital, one of the findings in some of the Diaries work is people aren't taking credit. Well, is that any surprise? It's expensive and it's very fixed term, and the products don't match what people need. And so I think we need, and what NRLM is actually doing is getting, credit out to people at 12%, 7% if they pay back on time. That's a dream in Africa, even with the best data in the world. And they're subsidizing. I mean, the Indian government is literally taking a lot of the pain points of inclusive finance, from payment systems to rural outreach to bank accounts, and they're subsidizing it. And so commercial operators can kind of come in and plug into that and play. But if you look at Kenya right now, you've got the government sort of pushing this big hustlers fund because they are trying to solve for the same thing. So the Kenyan government learned a while ago that if you put on interest rate caps, it shrinks capital. Or it shrinks credit. And so that wasn't a good move. So now they're trying to experiment with other ways to do this. And so what is the best way for public money to kind of play in this space. I think what we're trying to do is think about ways you can do it in a market creating way rather than a market destroying way. There's certainly regulatory interventions. I mean, it costs an enormous amount to be a bank in a place like Uganda. Can we think of lighter regulatory structures that kind of give people steps to, like Peru has, for example, in their regulatory framework? And so, you know, I think low cost funding, regulatory change so that it's a little bit more light touch and easier to operate. Fintechs don't have to comply with those standards, right? So like figuring out regulation that matches what we're trying to do. Operating models really need to be looked at to bring the price point down. I mean, I think there's a lot on digital and financial education. And what technology allows us to do now is to do that in the moment, right? To provide that kind of short, quick financial education, digital education through apps is when people start getting smartphones. So I think there's a ton that we have to play with now. So, yeah.
Thanks, Greta and Ami. I'm going to turn it back to Swati.
Thank you, guys. We've got some very interesting questions in the chat, but I want to make sure that we give Shashi a chance to talk a little bit about, specifically from the provider perspective, you know, what are the challenges that you faced in we understand that segmentation is important. It allows us to build more specific products that are fit for purpose for the borrowers. But, you know, from a provider perspective, it comes at a cost. It means potentially retraining your staff. You have to get different parts of the organization involved. So from your perspective, when you do this at Sub-K, what are some of the challenges that you face in actually segmenting effectively your borrower base?
Thanks, Swati. I think this webinar has come very timely as we just announced a partnership and investment with a specialized micro enterprise lending institution in India. So that basically conveys the message that as we think of multiple segments, we also need to think about the ability to deliver, the specialization, the human capital requirements, the processes, technology. So there are so many areas that we need to be prepared with, right? So we have been traditionally a nano enterprise lender in the microfinance space broadly. And, you know, as we go up the ladder, we realize that, you know, it's not an easy shift and it requires a lot of capability building. So one way to do is partner with the specialty organizations that can actually serve that purpose. And then sort of as a combined entity, you act, you know, more from a strategic perspective. How do you look at these markets? So I wouldn't see anything as a barrier per se, but more so you have to travel that journey by solving some of the problems. The primary problem that, as I said, is the human capacity to deliver to multiple subsegments. But at the same time, you know, there is also this shift. Organizations like us who have been in this space for a long time, there is also a mind shift that is required to be done. So as we think about ourselves as evolving organization, customers are evolving much faster. So with digital coming in the way, there's a lot of discussion about fintechs. As digital comes in the way and customers trying to adopt to the digital methods of dealing with businesses, with financing, we also as providers need to think about how do you serve, you know, those evolving customer base. You know, within the broad customer, there is now a sub-segmentation more from a digital perspective. So we talked about digital readiness in your paper as well. That, you know, and digital readiness is not only about somebody seeking convenience, it also conveys a lot of messaging about what the customer's nature of customer's behavior is all about. If one good data point that we have noticed, you know, is that someone who is paying digitally is also paying before time and is paying regularly. So there is a risk aspect associated with the digital behavior also. So more the customer is digital, less the customer is risky and more disciplined, which means that they also are seeking a similar kind of response from a lender. You know, you cannot treat that customer as you treat any other customer. So you need to also, you know, fine tune your processes so that you are able to respond to that kind of an expectation of that customer segment. Now, this is a new segment, right? It wasn't there like 3 years ago. There is no digital customer segment. So now that segment is growing and is important, right? Because they are the ones who are demonstrating the urgency, the discipline, and also the need to change, right? When they are changing, as a lender, I should change much faster. So I think these are some of the things that as an organization we grapple with. How the customer is evolving, if they're growing to a larger, you know, ticket size or a growth phase of their business, the needs get diversified. As I said, early stage, they're mostly working capital. Now, as they grow, they need investments. They need long-term capital needs. They need lifestyle capital needs. So as you go up the ladder, there are different kind of needs that the customer expresses. Hence, we need to think of products, processes that deliver needs for that emerging segments, or the customer, one segment emerging to the next segment. So I think there is a lot of these aspects that as an organization we need to be prepared with. I think the ready to be changed as an institution has to be very critical. So the change management aspect is now a continuous activity for organizations like us. We don't say, hey, you know what, you ran a one change management workshop and everybody understood that there's a new thing that's going on. No, there is another thing coming on tomorrow. So we, as an organization, try to build a continuous learning culture, a lot of change management activities, all the way from board to the last mile. There are, of course, a lot of financial investments required. I talked about an investment we just made. So there is a lot of financial resource allocations that you have to think about for future while making sure your current business is funded. So I think there is that resource management aspect that comes in when you think about, serving various customer needs. And then at the end of the day, what matters as an organization is, a lot of us talked about the whole viability, the unit economics. Some segments we may not be able to good at. We will never be able to break even or, be able to serve that segment. Then we also have to be clear as a provider, what is your, space, what is your scope? So that all of us take that segment or that multiple segments as your core market and then try and do best possible. So I think that is also another area where we keep grappling. Should we stretch ours into agri? Should we get into larger ticket loans? All that stuff is a pull factors. But then as a provider, we need to be realistic about what is doable and what's not. And that's something that we continue to evolve, learn and evolve as we go along.
I see, when we'd spoken earlier, you did mention that the majority of your customers are women. Has that been a deliberate strategy? Has it happened by accident? Have you actually been building on some gender disaggregated data that you've collected? So how has that actually materialized?
Yeah, so one, we kind of been always gender intentional from the fact that we came from the bottom up, right? So we come from a microfinance background where we have seen gender actually played a very important role in defining the business models per se, right? So there is a very proven aspect that women customers are good customers. There's no reason to believe that they're not good customers. Let me put it that way, right? So that has been proven in the microfinance space. And we always thought that, we should take those learnings forward to even the next level of interventions that we do. So from that perspective, it is an institutional learning that has been there. And there is a very intentional aspect. We also run agent networks, for example. We also try and see how can we add more women agents to the network so that more women customers can be brought into the fold. Well, it's a very natural thing that unless you bring the whole household into the mix, right, it is half job done. So in that sense, we as an organization have learned as we've gone along. And we also realized that there are a lot of interesting behavioral aspects that we see. There is a tendency to think that, hey, women don't own a smartphone, so they don't probably pay digitally, and they don't have a bank account, so they probably cannot take financial decisions. I think these myths were already busted. So there is a family member who can help this woman. They actually grab the phone when they need to actually operate it. They all do WhatsApp calls. So I think we realized that women are good learners. It's not that they are just sitting behind and watching the men folk doing something in the household. They're learning faster, they are actually moving forward. And there is a reason to believe that, and we talked about NRLM program, Greta talked about the whole national livelihood mission. The whole mission is driven on women as a center, because family is a center and women actually is a front runner of the family in that sense. So we take that stand as well as an organization, that unless you serve the real player in the family, which is a woman, it really doesn't matter, who is borrowing at the end of the day. What matters is if the woman borrows, she serves larger household needs and larger business needs than, you kind of focus your whole business on men folk, and sometimes it's a bit too narrow. That's how we deal with it.
Very interesting. Actually, I think I'd like to get all of our panelists' perspectives on this. So Greta, if you could turn on your camera as well, and maybe Sai, you've been looking at the questions from the audience. Maybe if you could do one question, because this is a very important topic for CGAP around gender.
Yes, absolutely. And you know, we're coming up almost to the top of the webinar, and we haven't really spoken about gender because that's a whole webinar in and of itself. Now, my very broad, impossible question for the panelists today is gender as an axis of segmentation is very intuitive. Everybody tells us anecdotal stories about how women are better borrowers, they have better repayment behaviors, and almost all evidence seems to sit in anecdotes. Why is it so hard to design gender responsive financial services at scale? Where are the barriers? Is it the lack of gender data? Is it the lack of data analytics? Is it the lack of incentives to use such data in decision making? Of course, CGAP itself has done a ton of work on social norms. So it's $1 million question that I want to leave the panelists with. Why aren't we seeing more work in this space?
So I'm going to leap in there so that Greta doesn't necessarily have to, but you know, Greta has a comment in the chat that women are not a segment, which I would broadly agree with. And you know, there's another question in the chat about this as well. That's sort of in this line is one of the remarkable things we've seen in the Small Firm Diaries is that the women-led businesses are not materially distinct from the other businesses. Now, there's a big selection effect there, right? Because we went and purposely found the women who had employees outside the family. So these are women who had already overcome a lot of barriers. They have businesses that have capital. So they're women who had the access to capital to invest in the first place. But the reason I bring this up is, you know, in the line with what Greta was saying is there's a huge danger that we see not just in developing countries, but across the world as, you know, putting women into this box that women care more about their family and women care more about their children. And we do all of these sorts of things because it forces women into a particular kind of business and a particular kind of loan that becomes self-perpetuating and is, you know, just a different form of discrimination, right? We see in, say, Silicon Valley that there are very few women who are getting the kind of capital that allows them to take the kinds of risks that they do, in fact, lose all of the money and the company fails, right? We glorify that when men do it and generates a certain kind of behavior. If we sort of create this idea that women don't do those sorts of things, and that means women can't do those sorts of things, they can't take the really big moonshots. So as we design with gender in mind, I think it has to be, there are women who want to take super risks, who are capable of growing really big businesses, who are not wholly focused on their children and their families. And that's good. We should have products for those women too, and not just put women into these boxes where they can only be this thing, this sort of idealized family situation. Now, at the same time, we also need to recognize for a lot of very poor families, it is the women who are providing the base level of income that keeps the children away from malnourishment. We've got to have products for those women too, and not just say, well, you're not going to grow your business 100x. We don't care about you. You're not a target customer. But you know, that comes back to what Greta's saying. It's not women as a target. It's what are the different kinds of women, and let's give women the full range of segmentation that women have, rather than saying, women, you're in this box, and then male-owned businesses can be in these 17 other segmentations.
Thanks, Tim. Extremely important point on how social norms are self-perpetuating, especially in our work. I know, Greta, you have a lot to say, but before I give you the last word, Ami, and I do recognize we're at the top of the webinar. We'll wrap up in the next 2 minutes. Ami, Greta, 1 minute each. Go.
I want to hear what Greta has to say, so I'm going to keep mine to 10, 15 seconds. But no, I mean, I think it's a really important point. And again, I mean, I think this segmentation exercise more generally is the right approach, because yeah, to Tim's point, I mean, we've seen women fit in all of these categories. And again, they don't have to be, you know, we have companies that are providing inventory financing to small retailers in Indonesia, Mexico, Peru, using fintech solutions. And, you know, 70% of their customers are women, just because, you know, and they sit in different categories. Either they want that money because they're growing their business and they're trying to get that next shop. Some of them just need inventory to manage the cash flows, like we talked about, and that's fine. And so I think, yeah, that approach. I mean, one thing we're thinking a lot about is from a gender perspective, we aren't seeing, and as fintech providers, the access to digital tools is just something that's still harder for women to have access to. If either that's because, if there's a phone in the house, that's with the husband, or, there's some barrier there. And I think we need to get a little deeper in understanding with our providers what's driving that. How can you kind of better deliver access to digital tools, and thus, the fintech elements, the financial services that come along with that. But, I can't speak to what the answer is there. I think it is, though, something we're still seeing as a barrier.
Thanks, Ami. Greta, the floor is yours.
Yeah, so many thoughts on this, and I can't do it justice in a minute. So, yeah, women are not a segment. Others have said this. It's definitely an element that you want to segment by, but women cut across every segment. We're half of the population. Right. So I think we have to be a lot smarter about it, but we also have to look at, there is discrimination in the system. I mean, the World Bank did a really interesting study. We all sort of say, oh, we know that women are a better credit risk. Well, so why are women getting credit on crappier terms? Again and again and again, we're seeing this. The World Bank did a study that showed that men's enterprises have 6 times the assets of women's enterprises because they're able to get credit on better terms. Why is that? I don't know. Mexico and Chile did some data exercises to understand whether women were getting credit on equal terms to men. They were not. And then, there were some policy actions to correct for that. Somebody asked about sex disaggregated data. We're doing a lot on that generally in the economic sphere, but we're going to do some specific work, including with CGAP, on sex disaggregated in financial services, and particularly credit, because I think whenever somebody digs there, they find out that women are not getting credit on equal terms. And so back to segmentation, I think segmenting and really understanding what women need, because not only social norms, but the care burden that women bear, women maybe aren't able to run an enterprise on a full-time basis, which is why we're talking about things like subsistence entrepreneurs. They're bringing in an income stream for the family, credit benefits them, but it's in a different way. And so I think we have to really be thoughtful about what those segments of the poor are and how they benefit from credit in different ways, sometimes a resilience tool, sometimes an opportunity tool, and get a lot smarter about how we have this dialogue. And that will help us as an industry, because we will tell the evidence story better if we're smarter about how we're serving women and other low-income customers with credit and what that's doing for their businesses. Like, we just haven't been doing that in a very smart way up to now.
Thank you, Greta. And with that, we really have to close the webinar, although I would love to go on for another hour. Swati and I would extend our appreciation to all our panelists for their time and for our audience for tuning in. Please follow our panelists and CGAP social media handles for more work on this topic, and be in touch for more opportunities in the future.
And just a quick note that we have some really interesting comments and questions still from the audience, and we will try to pass them on to the relevant panelists and ask them to get back to you directly. But thank you very much. Very, very interesting discussion. We really enjoyed having everyone here.
Thank you. Thank you.
Thanks.
Thanks,
Bye-bye,
Sam.
everyone.